Hey, welcome to the show, Total Financial Solutions Safer Money Hour. I'm your co-host, Jeff Gerard, soon to be joined by Arif Halaby, and we have a special guest for you guys today. A man that I know pretty well here by the name of Gary Leach. Gary, thanks for joining us today on the Safer Money Hour. Appreciate you being with us today.
Cool, thank you. Pleasure.
Hey guys, we're going to talk about your family's finances, ways you can get out of debt, manage your money, plan for retirement. That's always the theme here, but today we have some special tips for you when it comes to securing a mortgage. What are the best tips, the best practices for you to get into a mortgage that's going to make sense for you? Number one, I can't tell you how many times I've seen people get excited, right? They get really excited. They go out looking for houses. And even before their mind is set on buying a house, they're driving around in a car, scoping out neighborhoods, different times of the day. They find a house. They're going on different, websites and apps, and they're finding prices of homes, and they get really excited about buying a house. And they haven't done a few things, I think, to secure some of the ways to get a really good mortgage, to have the best chance at buying a home. We get excited, right, about the purchase. We have all the bedrooms picked out where we're going to put the kids, and what we can do with this, that, and the other was regarding the property, and they haven't even pulled their credit report. So, Gary, how important is it? Well, first of all, before we get into that, tell us a little bit about you, your background in the mortgage business, and what you're doing now.
I've been in the business for 13 years now. I've been at Wells Fargo Home Mortgage for the past 6. That's pretty much my history in mortgage. So I feel like I have a lot of experience, a lot of knowledge. 13
years. Wow, you've seen some changes in the landscape, to say the least, huh?
Yeah. We're on the up swing for sure. Rates remain low. Prices are on the rise. The equity, a lot of people are having equity back into their homes now compared to 2006, 2008.
That's pretty interesting because we're seeing these changes kind of take place, and everybody's wondering how long rates are going to stay low. That's right, probably the question you get asked the most often, right? How long are the rates going to remain like this?
Yeah, Jeff, I don't have a crystal ball, but they're saying they're going to remain low.
Yeah.
Keep the money active. But going back to your question, as far as I think the most important thing is to get pre-approved, to have a strong pre-approval letter in your hand before you start shopping for homes. So you would meet with myself. We'd run your credit. I would obtain your income documentation, your asset documentation, whether you be a wage earner or you're self-employed.
Okay.
And then I would send that up to an underwriter, and we would have a hard pre-approval. So when you are out shopping, we would have that letter for you so you can make offers.
That's great. So now what you've done is essentially really gotten a lot of the heavy lifting out of the way with regard to being approved for a loan. You can see how much of a home you can buy, which is really the key. Because if I'm looking at $1 million homes and my budgets really should be in the $500,000 range, then there's a big difference there. So that's really helpful. And then the next part would be to meet with someone about finding a home. And so you're saying now with this pre-approval letter, that's basically kind of your golden key to see about making offers on homes, right?
Yes. If we had that purchase price nailed down, your down payment scenario, whether it's FHA or conforming, that's how we would go about that.
Okay, so you said FHA. So are these like specially tailored programs or backed programs? How does that work?
FHA financing will allow you to put 3.5% down.
Okay.
And more geared towards people that had credit issues in the past.
Okay, so there's a program out there, is what you're saying. If someone's had some financial difficulty, maybe their FICO score isn't where they'd like it to be, there are some programs out there. Okay,
Absolutely.
So FHA is one of them, and that's
Absolutely.
Federal Housing Authority, is it not?
Yes, administration, yes.
Okay, so that allows them to put down a lower down payment than the traditional amount. What's the traditional amount that you're saying now?
We also, Wells Fargo just rolled out with, it's a program called Your First Mortgage, which is a conforming conventional loan product, and it'll allow you to put 3% down.
Nice, so 3%. Now, do you have to be a first-time home buyer?
You don't.
Nice.
That's one niche about our program. You don't have to be a first-time home buyer.
That's pretty exciting. Okay, because a lot of people are thinking that the number in my head is always 20%, to
Right.
try to avoid a few things like mortgage insurance and things of that nature. So if somebody starts out on one of these programs, do they expect something like that, where there's maybe mortgage insurance or things like that?
Yeah, we can do lender-paid mortgage insurance, or you could have separate mortgage insurance.
Okay.
We go anywhere from 3% down, 5% down, 10% down.
And then really, what's the difference between putting down a lower amount and a higher amount down? Is it just the payment that's going to be the consideration?
Your payment and rate, yes.
Payment and rate. Okay, well, that's pretty cool. And then when it comes to, I hear this a lot, is the debt to income ratio. How important of a factor is that when it comes to a home? And what are you finding is a ratio that works when it comes to qualifying?
Very important, Jeff. Very important. To get qualified for a loan, it's all about a few things. Your FICO score, how much debt you have. If you have car payments and and we compare that to your incoming monies of your employment, it has to be under 45% back-end ratio.
45.
So that'd be your total housing, new payment, principal and interest, tax and insurance, and also whatever we find on your credit report as far as car payments or monthly credit cards.
Now, is there a type of a line of credit or maybe a car payment, for instance, that might hinder someone from being qualified? Is there something that stands out when it comes to lenders looking at it and underwriters going, they have a little bit too much credit card or automobile payments? What's really the thing that people can kind of stray from when they're buying a house? Because I've heard, don't buy a car right before you're trying to get qualified for a house.
You're absolutely right. You're absolutely right. Like I said, it's all about how much debt you have and how much income you have.
Okay, so that's really the key. And then underwriter discretion, basically, right?
Yes.
Okay, well, that's pretty neat to know. So how can people improve that? Do you think maybe when they're looking at, let's say they're over 45%. So what do you find? Are you helping them, helping consumers look at ways that they can maybe reduce some of that to kind of get into that band or that percentage that they can actually qualify? Sure.
I have certain buyers I work with, and we have a strategy for, put you on a 6-month plan, and you pay off your debt. You pay off your cars to make sure you meet those ratios and you qualify for that home you want to buy.
I see. Okay. And then how important is it to come with a strong down payment, and does that affect someone actually qualifying for a loan?
It's important for sure. Your assets, your down payment. It could always be a gift from a relative as well, as far as funds coming to the transaction. Yeah, it's all important. Every aspect of the process is important.
And then if you don't have a strong down payment, I don't hear much about people having a second mortgage anymore for the down payment. I just haven't heard about it. But is that still something popular or prevalent, or what people are doing?
Yeah, I don't do a whole bunch of that. But it could be something we could look at.
Okay, so there is still a chance that someone could come with no cash, no rich relatives that can loan them money, and maybe get a down payment somewhere.
We have a VA program, which is 100% financing. So for any veterans out there, that is probably our best, one of our best loan programs.
Okay, well, tell me about that. What is that? What do you have to do to?
We can
you have to be active, or can you be retired?
Yes, you can be retired as well. Just need a certificate of eligibility from the VA. Provide that document, and we can do 100% financing.
Okay, and then going back to the debt to income ratio, what debt is counted when they're looking at what's on your credit report or total debt? How does that work?
Just whatever we pull on your credit report, we'll associate it. Student loans, car payments, any credit cards, pretty much whatever's on your credit report.
Okay, I see that. That's pretty interesting. And, I think a big part of this is, I'm hearing this a little bit, and I just actually had a conversation with someone over the weekend who was talking about buying a property out in Leona Valley. It's a beautiful property, about 10 acres. The home needs some improvements, and they're having some issues with the financing of that, but a big part of it was him being self-employed. So for our self-employed folks out there, entrepreneurs that are, certainly they're able to live in Santa Clarita. It's not cheap to live here, as we all know. So they're doing well enough to do that. They have the means to live here. They're meeting their obligations, but maybe because of the way their taxes are structured, or their corporation, or whatever their business looks like, maybe they're not showing a lot of bottom line income, which is typically a strategy that a lot of business owners use. They want to pay less in taxes, put more in their pocket, and have enough to operate their business. What can you say for folks that are self-employed? Is there a workaround for that? Is there like bank statements? Is there any other strategy to use where they can actually qualify for something?
Yeah, absolutely. We would just request, 2 years of their 1120s or their business returns and their K1s, and see what type of ownership they have in that company. I've recently done a transaction where a gentleman was a nurse, and he got his own practice a year later, and we considered that income, and he was qualified.
Wow. And then how about the business itself as an asset? Are you seeing any of that come into play?
Yeah, for sure, absolutely. As long as you're showing a positive trend, is what we look at.
Okay. And then if somebody has low income, but they have a lot of assets in the bank, let's say someone's retired, they've got, a few $100,000 or maybe more in the bank, but they don't have a lot of income because either it's, a low Social Security payment or a small pension, but let's say their house is paid off, their living situation is, hey, I've just got a car payment or two, I like to travel, I meet all my obligations, live within my means. Are you seeing that that's something that Wells Fargo has an appetite for?
Yes, we do have a loan program. It's asset dissipation. Sorry.
That's okay.
Dissipation, where we'll look at all of your assets and qualify you on those assets.
Okay. And then is there anything different about that, abnormal? I mean, is it basically the same process once you get qualified?
Yeah, instead of using your gross income, we look at your overall portfolio as far as your assets able to repay that note or that debt.
I see. Okay. And is that a hindrance in any way for anybody to get any of the programs, 15, 30 year, or whatever's going on out there?
No, we can qualify for whatever program.
What's your most popular program right now? What are you seeing people doing? Because I hear a lot about, the 15-year, and everyone's talking about the buzz of getting into a lower payment or a lower interest rate, but that means a higher payment because it's a shorter period of time. Are you finding people are doing that, or are they really sticking with the 30-year mortgage?
Yeah, I feel 30 years are most popular, more attractive. I say investment properties are big right now that are moving quickly. Owner-occupied, anywhere from 3% down to 20% down. I feel a lot of that is strong activity as well.
Okay. And then so some of those programs you mentioned earlier, do those also apply for rental properties? Or does it have to be owner-occupied?
Your first mortgage, no. 3% down, no. You would have to put minimum 20% down on investment property.
So it's still 20%. I've seen it as high as 25. So
yes, I create a better interest rate at 25.
I see. Okay. And then when it comes to fixed or variable interest rates, what are you seeing right now people are doing? What are they sticking more to?
We still offer 5/1 ARMs, 7/1 ARMs. They're fully amortized. Mm-hmm. There's no more interest-only loans at Wells Fargo.
Oh, okay. Can you talk about that? What does an ARM mean for the folks that don't know what that means?
Well, for example, if you had a 5-year ARM, it'll adjust in that fifth year. It could be tied to the market, to the prime rate.
Okay, so an ARM stands for adjustable rate mortgage.
Adjustable rate mortgage,
and it's
yes.
Amortized, meaning the payment is based on what, 30 years?
It's fully amortized over 30 years.
Fully amortized over 30 years, but
yes.
for 5 years, this gives folks a chance to get into a mortgage at a very low monthly payment, and then in 5 years they have the chance to either refinance or take whatever the payment is when it goes and changes at 5 years, right?
Absolutely.
Okay, that's a pretty decent strategy. I can see where that, if someone sees that their financial situation might be changing in 5 years or sooner, then this could be a strategy for them to get into a home and make the best of that. Well, hey, we're going to take a quick break, guys. Thank you, Gary Leach. We're going to have you stick around for another segment if you don't mind. We'll be joined by Arif Halaby. This is the Total Financial Solutions Safer Money Hour, tips and tricks for you on your mortgage and how to buy a property. What are the best ways to go about finding a mortgage that's right for you and your family that fits in your budget? We have those tips for you when we come back. Total Financial Safer Money Hour. We'll be right back.